Welcome to the 2022 Economic Preparation and Depression channel. I'm your host, Tony. Thank you for joining me once again on this October 2nd, 2022 Sunday edition here. We are fastly approaching the fourth quarter of this year, and I'm going to expect it to be talking about the inflation continuing as well as a cooling housing market as we head into the fourth quarter of this year. Thank you for your support. Please be sure to subscribe to this channel. Preach to me for the latest interpretation of financial news here. And as always, please consult your local financial planner. I'm not a financial planner, but I do any opinions expressed on my own. And we thank you for your support. So as you can see here, everybody's looking forward to retail shopping coming up for Thanksgiving, Christmas, and other venues that are coming up. And retail are hoping that the sales will continue to grow. Many of the companies are starting their sales period early. But the thing is that inflation has not gone down. It has remained steady above 8%. Core inflation, according to CNBC.com, rose 4.9% from a year ago and on a monthly basis. And I don't think I have to tell you, ladies and gentlemen, that you guys, ladies and gentlemen, you know, as you go to the grocery store, the gas pump, that things are still very high. Utility bills are still very high. And in Europe too, as well, in UK and other areas too, as the pipeline, as you know, burst in Europe. That gas pipeline, the Danish military service showed us the pipeline that burst. That brings the Russian natural gas. So all of this, whether intentional or not, is going to cause prices to remain elevated throughout this year and possibly into next year. So we have personal income expenditures rising in July, August, and September. House headline inflation is accelerated, quote, despite a sharp drop in gas prices. I think AAA.com, it said gas prices have dipped below $4 a gallon nationally. Now in California, they're still paying a lot more, obviously, but nationally, we're down below $4 a gallon now. I think $3.92 was the average price for an unleaded gasoline. But so with this headlining us, we have all of these expenditures increasing, and the market is volatile. Most economists, quote, according to MarketWatch.com, see the U.S. turning into a buyer's housing market in 2023. Interesting. Here's where you see the biggest declines in value. So right now, homes are taking longer to sell on the MLS, on the realtors list. However, the sales are still there in a lot of the hot markets in the Northeast and Southwest and in the Midwest. I mean, down South, I should say. But that trend is slowing because now mortgage rates are climbing almost above 7% right now this week. As you know, 6.7% is the average mortgage rate on a 30-year fix right now. And that has allowed some buyers to kind of like pull back and wait until they know a cool down is coming. And so home prices are coming down. People are offering 30K discounts, and the builders, some of these big builders, like Ryan Homes or Toll Brothers, Pulte Homes, etc. They're offering up to help up to $20,000 in helping closing costs on some of these properties here, on these new subdivisions that they're building, and townhomes and big houses that they're building out, custom houses that they're building. They're offering bigger closing costs, and they're doing so as a result of, they're saying that they're having a harder time getting supplies such as like appliances, stoves, dishwashers, microwaves. Big appliances are taking longer to come, obviously, because the supply chain crunch is still happening. Now, unfortunately, that means that when this housing market cools, that means that in the next 2-3 years, that means that prices are going to come down. Equity is going to be coming down on houses. The appreciation value is going to be coming down. Some of you have already reported losing 10K in equity or more just as we start the downward slide with this housing economy. So stocks in September are down 9.3%, the worst month since March 2020. And we really have to watch the S&P 500 because the other stocks is only made up of 30 big stocks, the big guys, and the S&P 500 gives us a complete picture, and that was down significantly on Friday, almost 500 points. And guys, so we're losing a lot of points. This is the worst monthly skid, quote, since March 2020, when the pandemic crashed the global markets essentially. And so this is going to be a long type of recession. So, and it's going to last after the results of the midterms and et cetera throughout the term, the rest of the presidential term here, heading into 2024, 2025. We're still going to be in this downturn, this recessionary. It's a slow slide down the hill. Remember, when you have a $15 trillion U.S. economy, the biggest economy in the world, it takes time for it to ripple through the system. And now we're just seeing the effects of the money printing, the stimulus. We had 3 stimulus packages Plus all the money given to Ukraine, all the money given to other countries, all of that's coming back right now. And then that's not the count, ladies and gentlemen, the disaster, the natural disaster. Our prayers are with those, of course, Hurricane Ian, hit the same area Hurricane Charlie hit, that Fort Myers, Punta Gorda, Port Charlotte, Fort Myers Beach, Sanibel Island, all of that area. Prayers and thoughts go with the families down there. I'm glad that the governor issued that. I'm not political, not getting political here, but I'm glad that Governor DeSantis did issue that mandatory evacuation. That's what required of anybody. When you get a 15, 16-foot storm surge coming in there. So I'm glad he issued that early, so most people heeded that warning and got out of that zone, because that, when you have a big hurricane like Category 4 coming, it creates a 16-foot bubble of water that basically, comes inland and destroys everything. Water is a very powerful force. So I thank God that that was issued, and that many people's lives were saved because of that. Our prayers are still with the recovery. Now back to what we're showing here, guys. We have mortgage rates hit 6.7%. That's housing market cools. Okay, so we have less qualified buyers, because that's if you have, you gotta have great credit, I guess, above a 750 FICO and all that stuff, 10% down, 20% down, or 3.5% down, however loan you get. But that means that these rates are likely going to be more 7%, 8%. And that's going to mean a lot. That's going to mean a lot, because even though prices are cooling, we're still not going to be below where we should be pre-pandemic levels in terms of housing prices. They're still very elevated. That rancher, that 150K rancher that you used to get in the Midwest and in Texas, or in Oklahoma, or some other place, that's now going for 350 or 400K. It's still vastly overvalued. The same thing in Florida and the other places. Those houses that used to be between 250,000 and 300,000 are now selling for 450, easily 425. Were during the height of this housing bubble, and so that takes a while for it to come down. It's going to take a while for that bubble to come down. Like the guy says here, the economist says here, we aren't crashing, we are leveling out. He says we're just trying to find out what the level price is. That's what everybody's trying to figure out. Well, we still have a long way to go, because the Federal Reserve Bank is still committed to raising interest rates. That's what Jerome Powell said. Chairman Jerome Powell said he wants to get inflation down to 2%, and we're at 8% now. So you do the math. We've already had 4 rate hikes, and he still have 2 more left this year. 1 more left this year. Sometime in, I think, November or December, there's another rate hike coming, and then next year he's committed to rate hikes. So we'll have to see. We know in the UK that the rate hikes, that the rate hikes of their economy hadn't brought down inflation. Inflation in the UK and British and other areas at 12%. And we're looking at, everyone's trying to figure out what's going to be the next bubble to pop. And I think it's going to be the housing market. The credit market will be the last bubble to pop. I'm talking about both commercial credit for small businesses and for personal credit. That'll be the last bubble to pop. The credit market in the U.S. dollar, basically, essentially. And then we'll be officially in hyperinflation. So the housing market will be coming up next, but that's going to take, like I said, all of next year, and then possibly 2024 too as well. And then for that to cool down, and in 2025 we can see what level we're at. But that's going to be the next bubble. And then of course that's also dependent upon job losses too. Right now the job economy is strong because people are taking on extra jobs to help make ends meet. However, all of that is going to be ending soon, after next year, after people realize that these prices, inflation is not coming down, and it doesn't make sense working myself to death 80 to 100 hours a week if I'm not going to be able to enjoy, they're just going to end up cutting more of their standard of living down in terms of extra things. Like, maybe they don't take 3 trips a year, maybe they don't take 1 trip a year, maybe they cut the cable, maybe they cut the school kids after school sports programs that require money, or, music lessons or whatever. Those are going to be the decisions made on an individual basis. And as always, just because the media says the housing market is cooling, and by all means, it's an individual choice. If you feel like you need to get a house this year or next year, go ahead. I'm not a financial planner. You can still do that. People are still buying houses and everything. It's a good investment. It is a primary way that most Americans build wealth, have an asset. Especially with rent prices, because rent prices are going to be going up regardless. And you and I know that. In most of these states, the minimum rent payment for a 1-bedroom was above $1,400 a month. So that just shows you how things change over the years. So definitely, but just be careful. And continue to plan and continue to have that reserve, whether it's a medical, food, security, lights out. The same thing. Those people in Florida found out about the light things, the lights out, even if you weren't in the immediate zone that was impacted. Many people in the central Florida, or even South Florida, like Orlando or Daytona Beach. All those people, they lost power, and if they didn't have a generator, it could be out for 3, 4 days, until they crew. We have a lot of linemen down there from other states with mutual aid agreements, but that takes time, to get that many people up. It's still 800,000 people without power. So think about those things. Think about getting those things, small things at a time. Even candles, matches, things like that, lighters. Food supply, 5-year food supply from Patriot Supply. I know they're pretty good. A lot of people use them. That gives you calories. Just different things that you can do, because the bottom line is we're going to be experiencing more natural disasters, and that costs money, billions of dollars already in estimates. And sometimes the insurance companies, they go out of business, like in Florida. A lot of insurance companies are going to go out of business. It's just going to be a total loss because excuse me, they're not going to have the money to pay out. So those are the kind of emergencies that we want to prepare for. We know that we can't prepare for everything as preppers or as or as leaders in our family, but we try to prepare for the basics, have the basics covered, because like my granddad always says, cover the basics or the basics will cover you. So that's the bottom line. Anyway, enjoy the rest of your weekend wherever you may be in the world, and God bless you. And I'll talk to you next time as we get started. This next week started in the first week in October. Blessings.